talking today about snowbird planning for Rhode Island residents by transferring their real estate to Florida or other states through LLCs to mitigate Rhode Island estate tax. Okay, so this is a big thing. And I'd like to start with several questions, but one area, Joseph, that I'd like to jump into is what is the difference between a will and a trust?
Well, the big difference is that a will, which has been around since the Middle Ages, has to be probated, meaning that the will is a set of instructions that needs to be taken to the Rhode Island probate court by an attorney when someone passes in order for the probate court system to supervise the administration of the estate. Whereas trusts, which have also been implemented for many, many years, are a little bit different in that they're sort of like a living, breathing document like the Constitution, in that they survive someone's death, and it is a private contract or agreement between you and your trustee, much like an executor, to settle your estate. But the administration typically is without probate administration. So this contract between you and your trustee allows the trustee to hold your assets upon your passing and then distribute them to your heirs in a very economical manner, and typically a little bit more economical than going through the probate court administration system, and also avoiding an inventory tax and court supervision.
What are some of the estate tax implications if you pass as a Rhode Island resident?
Well, unfortunately, Rhode Island and the Commonwealth of Massachusetts have two of the lowest state estate tax exemptions in the United States. Estate tax is the tax that kicks in not between husband and wife or spouses, but rather when both spouses pass and assets are going either to the next generation or to other family members, i.e. non-charitable beneficiaries. In that circumstance, Rhode Island assesses an estate tax at an approximate 10% rate, it's a sliding scale, on assets above $1,840,000. And so hypothetically, husband passes, everything goes to wife, and then wife passes away with a $3 million estate, inclusive of real estate, life insurance, IRAs, and brokerage, which a lot of people think life insurance is not taxable, but it's includable for estate tax purposes, even though not income taxable under the Internal Revenue Code. Essentially, when you add everything up, husband passes, everything goes to wife. Then if wife's estate is $3 million, the exemption being $1.8 million, you are $1.2 million over the Rhode Island exemption. With a 10% rate, an unsuspecting couple bears an estate tax in Rhode Island of $120,000.
Wow.
And that tax can be avoided by implementing a souped-up will called a revocable trust. If husband and wife each utilize a revocable trust, they can each use their respective $1.8 million credits and not waste them if one spouse dies. Thereafter, passing in excess of $3 million to the next generation without any Rhode Island estate tax. So in that same $3 million example that I provided earlier, just by a simple upgrade from a will to a revocable trust, a Rhode Island couple can avoid $120,000 in state estate tax. So it's very advantageous. Most of our Rhode Island couples pass away not with a will, but a revocable trust. Remember that this credit shelter type of planning is only available to couples. Single persons only have their $1.8 million credit.
Let me ask you something for the heirs, okay? Are they, when they receive money, through an estate, are they taxed on inheritance? And if so, how much?
Well, the tax kicks in, as I just modeled, if essentially the estate is over $1.8 million for a single person or over $3.6 million for a marital couple. So there's the estate tax that is paid for typically by the estate before assets can be distributed to the beneficiaries. And then there's the income tax implications. Under the tax code, if you do the planning properly, when someone passes and assets pass to the next generation, they pass with an income tax step up in basis, meaning that the beneficiary can receive the asset without bearing a capital gains tax or embedded income tax, with the exclusion of two types of assets. One, a qualified assets, meaning IRAs, 401ks, 403bs, and annuities. Those two types of assets under the Internal Revenue Code don't get a step up in basis. And so when the beneficiaries inherit those assets, as they liquidate embedded annuity money and or take RMDs on IRAs as an inherited beneficiary, then they bear the income tax at that point in the future. Now, under the current rules, when an IRA beneficiary or creator attains the age of 73, they have to start taking out required minimum distributions over a little over 20 years, anticipating that all of the money will be distributed out to that beneficiary or participant during their lifetime. When parents both die, under the relatively new 2016 Secure Act rules, inherited beneficiaries must take out all of the IRAs that they inherit from their IRA proceeds they inherit from their parents, either immediately over a systematic 10-year period, or they can hold everything up until the end of 10 years and then take everything at the end of 10 years, but with the embedded income tax. That's why most tax planners advise children who inherit IRAs in the future from their parents to take them systematically over the 10-year period.